right, let's talk about one of the biggest decisions any growing business has to make, getting the tools you need to actually grow. Today, we're diving into equipment financing so you can make those big moves without crippling your cash flow.
So you're at that point, right? That new machine, that upgraded tech. It's the one thing standing between you and taking on bigger, better jobs. It's an awesome feeling, but it also brings up one huge question.
And that is, how are you going to pay for it? Because let me tell you, just dumping all your cash into one big purchase is so risky. It can leave you totally exposed if something unexpected comes up, and it can literally grind your day-to-day operations to a halt. So that brings us to our first big topic: why even finance in the first place? Let's break down why it's often a much smarter move than just writing a massive check. You know, this quote just nails it. When all your money is locked up in one piece of metal, what happens when a huge new opportunity comes along that needs cash up front? You're stuck. That right there is the growth trap. You really have to think of financing less like a debt and more like a strategic tool. It lets you keep your cash for the important stuff, like payroll or inventory. It means you can get your hands on new tech way faster. You can even set it up so your payments are higher when you're busy and lower when you're not. And here's the kicker: every payment you make on time helps build your business credit. That makes everything easier down the road. Okay, so once you decide to finance, you're going to come to a big fork in the road. Are you going to get a loan, or are you going to sign a lease? They sound kind of similar, but trust me, they affect your business in totally different ways. So let's just break this down. With a loan, you own it. It's yours from day one, but you'll probably need a down payment. With a lease, the financing company owns it. That usually means little or no money down and a much faster approval process. It's the classic decision, right? Ownership versus flexibility. All right, so for this next part, let's just assume you're leaning towards ownership. You're thinking, I want that asset on my books. Well, let's take a quick tour of the most common loan options you're going to run into. First up, the old classic, the traditional bank loan. This is the one everybody thinks of first. It's your standard, straightforward loan with clear repayment terms, and it's usually the go-to for businesses that have been around for a while and have a solid financial history. But here's the trade-off. The big pro: you're probably going to get a really competitive interest rate, but the cons, well, they can be a deal breaker. Banks are super strict, the approval process can drag on for weeks, and you'll almost certainly have to put up other business assets as collateral. And that brings us to a super popular alternative: a dedicated equipment financing loan. The genius of this thing is that the equipment you're buying is the collateral. That makes the whole deal way less risky for the lender. So the real advantage here is that the equipment secures its own loan, which means your other business assets, or even your personal ones, are safe. But the flip side is simple and direct. If you stop making payments, they come and take that specific piece of equipment. Then you've got vendor financing. This is when the company that's selling you the equipment also offers to finance it for you. You can think of it as a one-stop shop for the whole deal. The biggest plus here is just pure convenience. I mean, you handle the purchase and the financing all in one conversation. They might even bundle in stuff like training or service. But the potential catch? You might pay for that convenience with higher interest rates or terms that aren't as good as what a bank would offer. But wait, the options don't stop there. For businesses that might not fit into a neat little box or just need more flexibility, there are some really powerful alternative ways to get financing. Let's look at two modern approaches. First, there's asset-based lending. Basically, you unlock the cash that's tied up in things you already own, like your inventory or unpaid invoices. Then there's crowdfunding or peer-to-peer lending. This is where you bypass the banks entirely and borrow money directly from other people online. And that can mean much faster decisions. Okay, we've covered a lot of ground: loans, leases, all these different alternatives. So now for the most important question of all: how do you actually pick the right one for your business? This 5-step framework is your guide. It's your checklist. First, look at your cash flow. Seriously, can you actually afford the monthly payments? Second, compare the total cost, not just the monthly payment. Look at all the interest and fees. Third, are you even eligible? Be realistic. Fourth, think about flexibility. What if you want to pay it off early? And finally, and this is so important, talk to your accountant. The tax difference between a loan and a lease can be absolutely massive. And now for our final section. Once you've figured out your path, how do you actually get to yes? Let's pull back the curtain and look at what lenders are really looking for. First up, the down payment. You've got to be ready to put down somewhere between 10 and 20% of the price. The more skin you have in the game, the better your chances are, and the lower your interest rate might be. Next, yeah, it's your credit score. There's some wiggle room, but most lenders are looking for a score north of 600. If your score is a little lower, don't panic. That's when having strong collateral becomes even more important. But here's a huge trend to pay attention to, something you see people talking about all the time. More and more, it's not just about your credit score. Lenders are getting laser-focused on your cash flow. They want to see consistent, provable income more than almost anything else. So, to give yourself the best shot at getting approved, get these 4 things buttoned up. First, get your financial records organized. Second, have a simple, clear plan for how this new equipment is going to make you money. Third, show them your overall debt is under control. And finally, have your bank statements ready to prove that you've got consistent cash coming in the door. Look, at the end of the day, the right piece of equipment can be an absolute game changer for your business. It can unlock growth you didn't even think was possible. So the real question isn't if you should invest, but how you're going to do it smartly. What's your next move?